You're listening to Founders on Air with Steve Orenstein and Mike Rosenbaum.
This podcast is sponsored by Zoom2You, Australia's on-demand courier marketplace. Get your parcels delivered within hours rather than days.
Today we have with us David Leslie, the Investment Director of Ellerston Ventures. Welcome to the program, David.
Thanks, Steve.
So David has 23 years experience in technology and investment markets as a researcher, an analyst and an investor. So Ellerston Ventures has raised about $150 million over the last 10 years. So we're very lucky to have someone like David on the show. So thanks so much for joining us and taking out the time.
No worries.
So why don't you start telling us a little bit about Ellerston Ventures and sort of how it got started and what you guys do?
Okay, so Ellerston Ventures, Ellerston is a broader business, manages predominantly public equities. So the day job at Ellerston is Australian equities, international equities, big cap, small cap. And then around 10 years ago, as part of the general investment team, I began to focus on private and unlisted investment opportunities. So effectively, the ventures business was given birth to back in 2010 when we invested in Mike's business, was one of the first deals that we did, Deals Direct. So since we started investing in unlisted companies, we've gone through iterations of doing bespoke one-off transactions, and then we moved into a venture capital fund. And now we've got a new fund, a growth fund called Jade, which is sort of later stage expansion capital.
Excellent. And what are the types of people that make up the business?
So across Ellerston, we've got experts in a whole range of different markets. We have investors who specialise in, industrial businesses, healthcare. We have others who specialise in financials and resources. Within the ventures team specifically, we have a broad investment background around technology companies, but complementing us is also our operating partners. So unlike listed investments where, if you change your mind, don't like it, you sell it, once you're involved in unlisted companies, obviously, we like to bring resources to bear. So our partners are former executives from, a variety of companies. Anthony Klock used to be the CEO at Betfair. Jamie Odell, Tony Casanos were senior executives at Aristocrat. We've also got one of the former founders from Seek, Matt Rockman. Carl Jackson founded Ozsa. So we bring these people in and they come into our sort of fund as investors in some cases, and then they also help us out with our investments by providing some operating experience and mentoring the management teams.
Yeah, excellent. And where do you raise your money from? So what sort of types of investors and what sort of checks are they writing?
Okay, so we have a wide sort of pool of investors. So rather than getting our money from institutions, it's from individuals. Mostly those individuals participate through their financial planners. So the Jade Fund predominantly has raised money through financial planning networks, and our fund actually has been rated by independent research houses and is able to sit on platforms such as BT and a variety of the traditional funds management platforms that people choose to make their allocations of their wealth. So one of the things that we've been able to do that's a little bit different from many of the other unlisted funds out there is to be able to create a structure in an open way that's an open-ended unit trust. So it basically provides access for retail investors. So we have a PDS. So, you don't have to be a wholesale or sophisticated investor to invest in our funds. Rather, you can apply directly, and so there's, I think the minimum investment size is $25,000.
Yeah, right.
So it's not just for rich people, endowments or institutions, it's actually a more widely available investment vehicle.
Yeah, excellent. And so how did you get started at Ellerston and in the VC world in investments?
So my first, sort of out of university where I'd studied finance, my first job was working for a multinational IT company, EDS. And so I worked there as a financial analyst for 5 years, learnt a lot. Then my career progressed. I ended up in stockbroking. I worked for Deutsche Bank for 5 years where I was covering technology and a range of listed companies. That then evolved into a funds management analyst position at Ellerston/CPH, Consolidated Press, back around 2005. And so my journey has sort of been back to where I began. So having done sort of general investments and focused on listed companies, and I spent a couple of years overseas and whatnot. As I came back to Australia in sort of 2009, increasingly my focus was around technology businesses, which is where I'd started out, and then eventually I just saw more opportunities in the unlisted sector. So together with the people I worked with, we sort of built out our capability around those unlisted investments.
So David, how many ventures or businesses have you invested in to date since 2010?
So through the club investment deals, we did about half a dozen of those. Then we did the fund, which was another half a dozen. We've made 3 investments so far in the Jade Fund, and I've made a couple of other small investments, in my own right. Mostly everything I've done has been through our Ellerston vehicles, but I've probably been a part of 15 odd investments. So by some standards, that's not a huge number in terms of venture capital land. We're probably a little bit more concentrated in our approach.
And what's the typical check size that you guys will write?
Yep. So when we started out doing the club deals back in sort of 2010, we were doing $3, $4, $5 million a transaction, and that continued to sort of be the model really up until we did the Jade Fund. With the new fund that we're investing in, we feel there's a greater opportunity and a slightly better risk-reward profile of later stage companies. So we're now seeking to write, $15 to $30 million checks. So we're looking for businesses with more revenue, so $10 million in annual revenue. I investors in Tyro, and so that's a company that's now valued on the ASX at nearly $2 billion. So we like the growth of the technology businesses at a very early stage. For us, it takes a lot of work. We have a very detailed process. We think there's a lot of scalability to what we actually do as investors. And we find the risk reward of later stage businesses works well for us and our clients.
Makes sense. And so what's the worst investment you've made to date, and what were the sort of key learnings from that?
Yeah, probably, without wanting to name and shame, I've certainly had a few that didn't work out ideally to plan, but the one that probably taught me the most lessons was more around a business that was a concept. So it was a really interesting business, around the world of sort of financial services, and it was trying to disrupt a very large and a very highly lucrative market within financial services. They had a working, functioning technology product and platform, but the volume of capital that we needed to use to generate real revenues, and when we were relying also on large financial services partners to work with us, it became very fraught about how long it would take, the regulatory requirements. So lessons learned, how long it takes big companies to move, the impact of dealing in highly regulated markets. You can never underestimate how hard and expensive that can be to navigate. And then ultimately, when you've got a new business and you're trying to acquire customers, you can't underestimate how much money you're going to need to spend on customer acquisition unless you've got a sort of proven channel. So whilst I think the idea is great and noble, it's still sort of sitting there and looking to be properly commercialised.
Thanks for sharing so openly. I think I can pick number 2. What's been the best investment so far, and why?
So investments, you like investments for different things. So we've been recently investors in Tyro, which listed 6 months later, and for anyone who's looked at the action since the IPO, the price has gone up a lot. So we've made a very high return in a very quick period of time, and it's fantastic. It's a great business, really well run and terrific. But I think part of what we're also looking for is businesses that can keep growing. And so if I was to say the business that's shown the greatest propensity to have a long duration of growth, it's probably Mabel, our home care business. So this is a business that we invested in over 3 years ago, and Mabel, when we first met the business, was very nascent. It was connecting. So what it does, first of all, is it connects people in the home care space. So think if you've got a client who has money and they're looking for services for someone with a disability or in the aged care sector, or maybe they just need some respite and home care. So there's a marketplace for people looking for care and carers who provide services. So you've got all these independent contractors who might be there to provide some basic home care needs, transport, logistics, not so much, the transport, but more home care and personal care in the home environment. This business started out at doing, when we invested in it, less than $100,000 a week of turnover. The nature of how this business works is it's solving a very large market, and the market's continuing to evolve and form. So people are transitioning from traditional agency models and government services to being able to buy their own services. And this is a business that, 3 years later, it's still growing at around 10% month over month. So what makes this particularly attractive and compelling as an investment is it's a very large addressable market, the ability to retain clients and have relatively low churn, and then to grow value with that client over time. So we see tremendous lifetime values and a business that has the potential to scale to a very large size.
Yeah, excellent. And with Tyro, sort of what makes you think, or what was the reason as to why the share price has grown so much over the last little while since it's listed?
So in Tyro, I think you've got a business that behind the big four banks is the largest payment processor in Australia. So it's got a strong market position. This is a well-established, we all do tap and pay. It's got very strong tailwinds in terms of the industry dynamics and trends. Why investors are really excited is the payments business is interesting, and payments are going to continue to evolve, and they've got a great platform and great client base to build on. But the fact that they've got a banking license and they're able to offer some lending services to these small businesses that are being so poorly serviced by the traditional big four banks, I think people can see, again, investors get excited where they can see very long duration growth profiles. If a business can prove, even at, with a couple of $100 million of revenue like Tyro, that it can continue to grow at 30% a year for many years to come, it's that long duration of growth that investors value.
Yeah, makes sense. And so when a founder comes to meet you, what do you like about, or what do you look for in that founder, and what don't you like?
So when you're only going to do 2 or 3 deals a year, you've got to be able to get on with people. There's got to be a high degree of honesty and integrity. You've got to be able to comfortably communicate with them, and you've got to be comfortable that they're going to be able to, take your advice, and when you challenge them, they're not going to be offended or discouraged, but you can have a constructive relationship. It's really important, and in some cases it's great where there's 2 founders. In other cases, you're looking for a strong individual founder. There's no cookie cutter or recipe. I can say that of all of the investments we've done, they always come through some warm introduction. So it's usually important that you're meeting someone not for the first time when they're coming in and asking you to invest in their business, but that there's sort of a little bit of a warm introduction that helps bridge the gap a little bit of the history to establish some of that trust and confidence. And that when they come in to see you, like I meet a lot of really bright young entrepreneurs who impress me, but you can't, and no one does. I think the world, everyone sort of graduated from thinking it's you go and have a meeting and someone's going to write a check. But it takes time, and I think, you've got to meet a lot of people when you're raising money. Investors, we meet a lot of people to sort of understand the mosaic of what's happening out there in businesses and what, but you're looking for that chemistry, that trust. Obviously the business plan and the data ultimately informs us whether or not, if the data's not there, if there's not enough revenue to meet our requirements, or there's too much risk in the business, then we're not going to invest. But we all have to sit there as an investment team, and we all have to agree that we want to work with that person and feel comfortable with them. So it's fundamentally about trust.
This podcast is sponsored by Parkhound, Australia's parking marketplace, to find a convenient parking space near your home or office.
Yeah, excellent. And have you got an example of where you haven't invested because of the way in which the founder conducted themselves, or something that you didn't really like?
By the time we get to the point of making an investment decision, it often takes 3 to 6 months. And so you rarely get to the end, and I haven't got to the end and said, you know what, I just can't work with this person. There have been, usually you figure out early on if, are they excessively optimistic and unrealistic and not willing to take a more balanced view on their own business. We've invested in young founders. We've invested in, CAMS, which is a company we just invested at, an Adelaide-based company. Young Joe's 61 years old, and, we've put money into his company. So we've got an open mind about what they sort of look like. We've invested with husband and wives out of, IntelliDocs in Canberra. So there's all sorts of models out there. We try not to be prescriptive, but we haven't got to the end. We usually know earlier on whether or not they're going to fit the mold for us.
What's that one investment that you wish you didn't pass on?
Well, there's obviously many.
Apart from Spacer.
Well called, Mike. There's obviously many investments that we've looked at over the years. We spend a lot of time worrying about the ones that we do. So I'm more concerned by making a mistake with the ones that I put money into. I try not to look back and have too many regrets. I think everyone who's not participated in the Afterpay story would sort of, share my pain. We saw it as a pre-IPO deal. One of your old mates, Paul Greenberg, might have been the first person who ever mentioned to me that it was an opportunity. So, I struggled back in those early days to think that lay-by model could work for what was basically an online business when it was first pitched. Little did I know it would have such a global impact. So, yeah. But that's probably the most profound one.
And what's your view on the economy today, both in Australia and globally?
Yeah, I think with an investor hat on, I think it's a difficult one. You know, it's hard. You have to be somewhat cautious. We're in unprecedented times in terms of low interest rates. We haven't had a recession in Australia for a long time, but we've got interest rates at a point where that lever no longer exists. So I think what that does is it puts a lot of pressure on us as investors and also entrepreneurs and business builders, because there's a lot of rewards for finding growth, whether we're investing or creating growth. I think there's a lot of opportunity. I'm genuinely optimistic that, you know, when we look at the businesses that we're investing in, and sometimes the prices we see test some of our sensibilities, but if we can find a business that has, and we've said it a couple of times, I've said it a couple of times, that real potential to grow for very long periods of time, then if we get the valuation wrong a little bit, that's forgivable. But finding businesses that can grow in difficult economic environments with low interest rates, the rewards are going to be material for investors. So, yeah, I think if I look at the changes happening in the economy, I think low interest rates obviously dictate a lot of investment outcomes and returns. I think technology will continue to be powerful, and very large markets such as financial services will continue to be tipped on their head. It changes everything we do, everything we consume. You know, so it's hard to be overly bearish. I think it's more a bearishness around traditional businesses that don't work hard to improve themselves. But from a macroeconomic, notwithstanding what happens in the US and China, which is way above my pay grade, I think domestically we're in an environment where capital's going to continue to go into businesses that are trying to drive growth, innovation, disruption.
So you've talked quite a lot about larger scale businesses today, and it's really interesting to hear your sort of investment thesis and how it's changed over time, I suppose. And you've often given me some great advice over the years. So what sort of advice would you give to founders that are thinking of starting a business today? How should they think about the world and you know, what they're about to start?
So I think it's really important that when you find a problem, that it's all about solving problems, I think. So you want to find big problems, not little problems. You want to find problems where people are going to be willing to pay for the service ultimately. So, you know, existing markets, large ideas, I think you're going to find that you get a lot more investor support. Doesn't mean that you can't, you know, the most inspirational founders in the world will create value where I can't see it. Maybe that's where Afterpay, you know, I couldn't, even though there were some large markets in the background, I couldn't see how they were going to get there. So I think my advice to founders would very much be on you've got to have big ideas. You've got to have ideas that don't, you know, some of the best founders in the world are deeply technical, and I think you have to have a strong technical capability or be able to at least translate and work with technical people, but there has to be a commercial lens to what you do. So I think founders have to be all-rounders. I mean, you know, if I was creative and capable enough, I'd love to build a business from scratch and be very successful. But, you know, I think it takes a special resilience. You know, all the great expressions, the failing fast and whatnot. I think you've got to be prepared to make plenty of mistakes, get a few bloody noses. But I think, you know, if I could give them one piece of advice, it really would be about solving big problems that are going to make a difference, because you'll get a lot more support along the way.
And you mentioned mistakes. So what are some of the classic mistakes that you've seen founders make being an investor? So
the main mistake I see sort of repeatedly is people coming in and, you know, Australian entrepreneurs, business people tend to try to sell you and tell you too much. They try to give you way too much information. I think the biggest mistake that people make is they try to overwhelm you with how much they know about something, when what we're actually looking for is clear ideas, clarity. Don't overwhelm me with how smart you are. Overwhelm me that you've got a clear idea that you're able to execute on, and that's going to be the focus of what you do. Bright, shiny things, you know, kind of burnt a lot of businesses. So I think we're looking, you know, you're looking for people with focus, not with sort of 50-page decks and lots of information. But you've got to know your numbers, right? You've got to know your market. You've got to know your product market fit, and you know it's going to be the 3 or 4 clear ideas that I get out of that meeting that are going to really inform whether we're interested in getting involved.
Yeah, makes sense. And what advice would you give to someone who's looking to reach out to you and get Ellerston Ventures to invest?
I think you can always try the front door. You can always try and send the email in, and you know, that's great. We look at those. You know, we've been logging information for a long time, so we do take it on board. And if it does fit into our wheelhouse of the sort of things we're looking for, we'll happily take the meeting. But if you get the warm introduction, I think smart entrepreneurs are smart enough to figure out how to build some good businesses and have great ideas. I think they can figure out, you know, how to get warm introductions. And even if it's not a direct introduction, I don't mind people reaching out on LinkedIn. I accept that all the time. I think it's part of being engaged. But mostly it's some sort of qualification, connection that gives me the confidence that at least the people you're dealing with, you know, there's a level of trust that you start with. Yeah,
excellent. And how do you think about valuations of these startups, and what do you sort of look at for the businesses and the...
So startups are hard. So, you know, we do our valuations of revenue, profit potential. You know, we look sort of 3 to 5 years out, and we look at what revenues a business might be earning. We take a view on what the unit economics are and the profitability is. We have a look at the size of the market. That informs us what the multiple might be on the business. But we try to look 3 to 5 years out. But we can't escape where a business is today, and you know, we do depend on data to inform us whether or not it's going to be, you know, the right one for us. So we're using data in terms of, you know, what are they doing today? What are the metrics around the customers they're acquiring? You know, what's the lifetime value? All of those things you'd expect to see. You know, when it's at a startup stage and it's a piece of paper and there's no real revenue to speak of, it's more of an art than a science. And I think, you know, at that stage, you're really relying on the people who are writing checks, and it's about finding, you know, I think a point where everyone feels the risk and reward meets their expectations.
Yeah, right. And over the last 10 years, what are you seeing in sort of valuations? Have they moved a lot, or?
There's no question that interest rates coming down have driven valuations up. So quite simply, the discount rate that people use over a range of high growth assets. So if you look at some of the valuation approaches to some of the recent IPOs, you know, when I was a sprightly young fella sort of 20 years ago doing DCF valuations during the first .com sort of market, you know, we were using WACCs of 12, 14%. People are now using 7% because if your risk-free rates come down dramatically, and that basically, you know, expands the multiple of revenues or earnings or what other capitalisation method you want to use. So there's no question that they've gone up, but there's a real economic rationale behind it. But again, you know, we've seen the movie before, so we're always watching carefully to sort of work out what might change those valuation paradigms.
So for 2020, what do you think the valuations are? Continue, or?
I think we're here. We're stuck, right? Low interest rates. Yep. So, you know, I don't think it's going to change dramatically, but it doesn't mean that the risk appetite for the market, again, you know, risk appetite obviously informs what discount rates you're using. If you think risk appetites are high, which I'd say they're reasonably high at the moment, that's great. But if you think that people are nervous that you're going to have, you know, some political, economic, global, you know, risks that can't get factored into the system, when that risk premium goes up, then valuations are coming down. So we'll have to wait and see.
David, thanks for joining us on Founders on Air today. You've been our first VC. It's been great to hear the other side of the story.
Thanks, Mike. And I don't know if we actually talked about it, but for those who don't know, obviously we were shareholders in Deals Direct, and we've had an investment in Zoom to You. So I know both of your businesses well and how you run them, and I can see with both the businesses you're running now, things are going great. So well done to you guys.
Thanks, David.
Thanks, David.
It's been great having you on the program, and thanks for sharing those great tips with our founder listeners today. That's all for us for 2019. It's been a great start. This is episode 11, and we're looking forward to getting to episode 40 by the end of next year. That's our BHAG. And just to whet your appetite, we've got a couple of great founders in January. We've got Adam from Humanitics, we've got Tristan from Lift Tango, Adam from The Iconic, and we've got the guys from Snapper. So have a fantastic holiday season. That's all from Founders on Air.
You've been listening to Founders on Air with Steve Orenstein and Mike Rosenbaum, a podcast designed for founders by founders to help you scale your business. For show notes and to ask questions for future episodes, go to foundersonair.com. Thanks for listening, and don't forget to subscribe. We'll see you next time.